Our next guest still expects the 10-year yield to end the year at 4.3%, which boosts his case for 4,600 on the S&P. Joining us now, Citi U.S. equity strategist Scott Chronert. Scott, give us a sense of how we get to those levels.
Well, I think it's important to recognize that we are still in the cusp of the 10-year yield as being the dominant influence right now. And you know, we're using a 430 end of the year level, which is our rate strategist view. I'd remind that when we were near the equity highs back in July, we were at that point arguing that 10-year was bound closer to 4%. So we're still in this world where I think the 10-year becomes more important as an indicator from here than does the Fed funds rate.
Oh, interesting. You note in your latest note that there's a clear division between leaders and laggards in 2023's year-to-date market action. Does that make this environment better for stock pickers or better for ETF purchasers and those looking to track the index fund?
Well, I mean, we think as we go into 24, the circumstances are going to change. It's pretty clear right now. You still have this momentum leadership around this mega cap growth or tech cohort. Going into next year, we think we're going to see a much more balanced sector earnings growth profile, and that should lead to a broadening out effect. And when we talk about our mid-24 target, which seems crazy, but we're at 5,000, that's going to entail ongoing leadership from bigger cap growth, but a broadening into other areas of the market that have been mostly left behind this year. So to Mike's point, I think we're looking at next week as an important signal because we're going to get a bevy of economic data that's going to support or not this ongoing inflation deceleration argument.
And by most accounts, you know, where we're at now with Q3, it's been a pretty solid quarter for earnings. It's just guidance that has really spooked investors. What do you think that portends for Q4, our current quarter, and going into next year?
Yeah, so, you know, we've been pretty constructive on the earnings picture for the S&P, and going into Q3, let's just set this up. We were looking for a flattish year over year. We ended up getting roughly plus 4% growth with Q3, but that came at the expense of Q4, where, you know, previously expectations were for plus 8, now they're at plus 4. What we think has happened with the Q3 reporting period is that you've got very expected cautionary commentary. But in general, the macro backdrop is such that we think going into the Q4 reporting period, we'll get another decent positive surprise situation similar to what we got with Q3 results.
Scott, you guys did a great note a few days ago just looking at fiscal sustainability and that whole conversation. One thesis you guys put forward was that the most palatable political solution might be to raise corporate tax. And I wonder if you guys are doing odds on that and whether or not it's putting a ceiling on the market.
Yeah, this is real, you know, thought stuff, Carl. But, you know, when we look at the deficit as it's set up right now in the CBOE projections, it certainly gets scary when you begin to factor in current interest rate levels. And we pointed out in our note that the CBOE's projections are based on 3% rates, which doesn't seem like it's the right place to be right now. So what we're suggesting is we get through the 24 election cycle and get into 25. We're going to have debt ceiling issues again, but we think importantly, the discussion around some combination of higher taxes, probably ways to fine tune or lower the government spending levels will have to come into play. And essentially what that does is introduce a potential era of fiscal restraint ahead. Which, again, it's out there. It's not something that we're basing our primary view towards the U.S. equity markets on right now, but it's certainly a consideration for us as 24 unfolds.